Professor Siegel, let's talk a little bit just about what we saw with inflation last week. That CPI number that we got on Thursday was hotter than expected. We've seen a lot of things that have kind of come through, and it has people thinking that the Fed is going to keep rates higher for longer. I know you've been an advocate of kind of slowing down, having them stop to see what's happening, but this weekend, Bullard from St. Louis, the Federal Reserve Bank of St. Louis president, said that he could very easily see, or kept the door open for 75 basis point hikes both in November and December. If that happens, what do you think happens to the economy?
Well, Becky, that core rate looked very bad, but let me tell you that it is not an accurate look at the core rate of inflation. Let me tell you why. 40% of the core rate of the CPI is shelter and housing. So let me give you a couple statistics that show you. The way it's constructed is so lagged that it way understated in 2021, way overstating what we have right now. Since March 2020, when the pandemic began, until this summer, the Case-Shiller housing index was up 40%. The Zillow and apartment list rental index was up 30%. Guess what the CPI shelter index was up? Only 11, because of the lagged way that they constructed. So this is Jason Furman, great economist. I think he's one of the CNBC contributors, and he's been on your show quite a bit. He decided last week, he said, well, what happens if we put a current rental, like Zillow rental, into the CPI index? And he tweeted this late last week, and the results were really shocking. What you got was that core inflation on a 3-month annualized basis, and this is a measure that Jay Powell has looked at, reached 16% in 2021. About double what the official number was. And by the way, it was in the first half of 2021 when the Fed said there's no inflation problem at all. Now, what's the bottom line? It way understated the inflation we had. We've had much more inflation. And now, when house prices are going down, when rental rates are going down, and I don't mean they aren't jumping from where they were a year ago, but not as high as they were now. If you take a look at these indices, we should have had a negative number there instead of a positive. And what that means, the way they constructed is we're going to get 0.7, 0.6 plus 0.8 for month after month after month. In 40% of the core, it's going to look horrible. Oh, my God, the Fed isn't succeeding. We have to keep on hiking rate, when it is giving a totally distorted view of the actual on-the-ground rate of inflation. I think that the Fed has to rethink about using current data, and they will see that their policy has worked and inflation is down, and those core statistics are not giving an accurate representation.